everybody. Once again, to our weekly discussion. Our goal here is to look at a bigger picture view end of the week, what happened this week, and how to understand, take actionable decisions on how to invest in this current market environment. So let me first of all say that yes, it has been a more volatile week. I think it's very visible, and if you look at the VIX and so on. If you remember last Friday when we talked, we were talking about how it was actually a pretty bad day, one of the worst days in the market last week. We did recover a lot of that losses, but I think generally the volatility is heightened. Um, it looks like I think market is struggling here, lack of catalyst you can say, and there's a lot of leverage, a lot of margin which is being used, and that is showing up in the market right now. So we will go through a little bit more on the charts to actually make sense, because it's always easy to see the price action and talk around that. But overall, I think what we can say is that market is just waiting in a wait and watch mode for for example, earnings. As we discussed last time, the earnings will start defining some of them. We did have some comments from I think the banks who usually report early, like JP Morgan and so on. There were some jitters last few days as the earnings came out. Some of the write-offs, they started showing the stress on their loan books where they had to take some big losses. That kind of spooked the market. Yeah, I think if you see what the comments from Jamie Dimon and also from some of the regional banks, this people are getting reminded of 2023 when the regional banks were in trouble. Let's talk a little bit through that, because market did react negatively yesterday to that, and there were some issues. But on the other hand, as we have discussed previously, and even during our investor day, that it's very different world from 2023, because at that time the losses carried forward on the bank, on the books of the bank, because of the yields being high, was way too higher, and that was a much bigger issue. What we are hearing now is more about the quality of business loans, yeah, in terms of because as you know that for last 2 to 3 years there have been predictions of recession, predictions of more defaults, and finally means this was predicted 2 years ago and now it's showing up. So it was expected. On the other hand, because the interest rate environment is changing, and we are going to talk a little bit around that, I don't think that is going to be it's like as big of a headwind just versus what right now yesterday what we saw being made out of it. So anyway, let's go back to the market first. Let's have a quick look at where we are. As we mentioned last week when we talked in this call, we had this big negative day, which was one of the worst. So if you see from a price action perspective, we are probably better off. Especially, I think as we can see, the candles are bigger. What does it mean? It means that we had more intraday moves. Even today, we opened really bad. We are going to touch base on what happened last night a little bit later. But basically, what we are saying here is that we had a recovery week. We are kind of sideways consolidating while the volatility is higher. Usually, when you have already made a top, you are going down and volatility is higher, it is kind of risky for the market. So let's understand technically that we are in a precarious situation. Unless we go and try to hit this again new highs, I think market will be worried. And what do we have now in front of us? Of course, I think the biggest news is always going to be the earnings. We are in October. Earnings are already rolling in. We did discuss the concerns around the bank earnings, which created a little bit of a hiccup in the market, which was yesterday. And now I think the bigger picture is that, as we all know, that the highest weight in indices and most of the people, they are investing into tech stocks. So everybody is looking forward to how the tech earnings will be. Early indication from TSM was good. I think they did not, they only raised their expectations. So I think overall, the AI trade is still in the play, nothing is changing. But right now, people are worried about the macro. So what are the macro issues? As we always say, right, means the yields are dropping because markets are expecting slowdown. We did see banks reporting, loan. And yesterday, if you see the yield almost touched below 4% after a very long time, and they were one of the lowest in some time, and that is mainly because of this concern. And today they are bouncing back because people are realizing that, as I was discussing, it's not as much of a structural issue. The reason being, we are looking at rate cuts, we are looking at their balance sheets improving from banks' perspective, because all their assets, which they are sitting in treasuries usually, those are going to be improving as the yields are dropping and the rates are falling. And from the rates perspective, I've never seen this before, but there is 0% chance of no rate cut. So if you see currently the futures are tracking almost, I would say 94% rate cut chance of 25 basis point, and there is a very significant high now, 5.2% chance of uh, 50 basis point rate cut, which I don't think anybody's expecting because of lack of data. And as you know that because of government shutdown, there is very few data coming out. The employment numbers, the all the other retail sales and so on, they are not being captured right now, not being released. So in when there is lack of data, the expectation from the market is a safer 25 basis point. But even more important is that there is no change in expectations for the second meeting, which is remaining this year. There is another 25 basis point cut, which is going down to 3.5 to 3.75 range. Now, given this scenario with the yields falling, I think the pressure on banks' balance sheet is reducing. So that is one area where the headwinds are different. When we talked about 2023, regional banks meltdown. So I don't think it's a big issue. But as we discussed, VIX volatility is high. Yeah, today when we opened, so what happened today morning, I think is very interesting because if you see we opened way lower and we recovered very fast. So there was a lot of buying today. But on the other hand, the volatility was at very, very high rate. Like this was almost since highest since the April timeframe when there was a lot of uncertainty on tariffs. So I think overall market has really seen this kind of a hiccup in the morning, and this was because it was expiry day. There was a lot of overnight liquidations. And biggest thing which was happening was the precious metals. As you see, the gold became volatile, the silver became volatile because there has been, if you look at the run up in both of these metals, it has been one of the most unprecedented one. Even though, as we have been talking about, this was kind of expected geopolitically. China and many other countries are buying a lot of gold and silver. The goal here is that as people are disassociating with dollars over time, they are doing it in a very, very slow manner. But what happened in last few days and weeks is that there have been more attention from the traders. So one thing you need to understand is that the pricing of gold and silver is determined in the paper market, which is very much manipulated in the sense that there's a lot of paper gold, paper silver. There's a lot of contracts being traded in futures market, where most of that is mostly speculators, or you can say people who are hedging it. On the other hand, when you have a sovereign nations like China, they are buying huge amount of gold and silver, and they're asking for delivery. That's where I think these kind of melt up situations happen, where you have to go back and buy back the contracts if you're short, and if you cannot deliver, and when there are more people who were shorting, just playing the price action and they cannot deliver, that's when the price moves too fast. So that is what has been happening. Last night, some of that got reversed because of the too much of long positions. While for all these days, the short positions were driving the price action because they have to go roll it. They have to go cover their shorts because there is physical delivery demand. What happened last night was because of this kind of overconfidence, or you can call it as a frothiness in the gold and silver market, we saw a huge meltdown situation where, first of all, I think silver is not as big kind of a asset class, but I think gold and silver both created a little bit of a meltdown situation, which impacted the SPX, which impacted, if you see Nasdaq also, everything started low. But because it was nothing to do with the US equity market in general, we saw very significant buying coming in intraday. So I think today's action was very interesting. We ended very well at the end of the day, which was a relief because last expiry was pretty, I would say, damaging to the market structure in terms of how large we had fallen. So in short, coming back to the summary, right? Means if you are not a trader, if you are just investor, what you can see here is we covered the worst case scenario last week. All the froth was already taken out of the market because it was a drop which kept on happening. We talked about it last week. And since then, I think it's more of a sideways move in short. And everybody's just waiting for these rate cuts, which are more or less defined, which are happening in next 10 days. And then we have the earnings, which is going to define now where this market moves. So overall, it looks like pretty much wait and watch market with the volatility being high because yes, there is a lot of margin. Yes, there is a lot of concerns, but I think we are back to 20 VIX, which is not a very bad situation from where we started today morning. And we just have to watch out how much more volatility we will see next week. But I think markets are right now uh, probably just waiting for the tech earnings. And that will really define where we are. Again, my comment about gold and silver, I think at the start of the call, people were asking about like, what is the gold and silver viewpoint. I think this is still a more of a deleveraging, you can call it. Just like we had last Friday, we had this in equity market. If you see in the context of how much rally we have been sitting on, this is nothing big. If you are looking at the long-term trends, the question is, yes, has it damaged enough? What happens next? Just like we saw in SPX that immediately after Friday, we saw a big recovery. If that happens, I think gold and silver are still in the bull market right now. There's no reversal yet. There is no signs in technically that we have a lack of demand. So nothing is changing there. I think one thing which is changing is Bitcoin. I think it is looking on the chart a little more weaker than rest of the assets. So we did make as we discussed last week, we had made a new high, which was a positive sign, but then the last Friday drop, it hit really hard. And while it tried to recover, but it's not as good as we saw in other asset classes. Today, it was also further in the overnight meltdown and all the assets, as we see there's some correlation always in the markets because of the liquidations. What we saw was that it did make a new low. It broke down below its critical levels, which is 107, 108K area. And after a very long time, we are seeing Bitcoin trading below 200-day moving average. So this is definitely a sign of concern for Bitcoin. On the other hand, as we have been tracking this flag breakout, and if you remember, this is where we took previous support, it is still well above that. So I would say uh, in a long-term view, it is still looking like not yet reversing. On the other hand, in short-term perspective, it's a pretty much something we have to watch out for, whether it reclaims the 200-day moving average, which is considered very critical. It's not that in this particular bull run we have seen this happen before. It's not that it has not traded below 200 moving averages. It's a matter of how much time it spends below it, how much buying we see in terms of volumes. So again, it's kind of at a decisive point, whether it sustains this kind of a move or not. Having said that, as we always say, right, the macro is still in favor of all asset classes going up. Where we have talked about money supply, we have talked about some of these rate cuts and how SLR will benefit. And one more thing which I would like to talk about is there was a speech which Powell gave this week, and one of the things which came out was that he hinted at some point we still have some small amount of QT, which is quantitative tightening, which is going on, and he hinted at that maybe taken off to support the rest of the policy initiatives to boost employment and so on. So I think there is another set of liquidity coming into the market as the QT stops. That means you're talking about another 5 billion, I believe. That's what they're doing right now per month. That can be added. So I think macro level, there's no change. It's just a matter of, I think what is happening right now is there was a lot of money coming into the digital asset treasuries. There was a lot of interest in Ethereum and so on. And all that had resulted into a lot of kind of sharp moves up. And we are right now, I think, kind of releasing that pressure. Technically, I would say it is something very closely you have to watch out is whether it goes above 200 moving average again. And most importantly, it has to, if it breaks down below this flag area, I would say around 103, 104K, we would have to get worried about. So that is where I think we are seeing the individual charts. As I said, market is seeing a lot of buying. What we saw today was like very interesting how overnight liquidation in futures market was taken as a great buying opportunity. So, and we ended very, very well. So I think there is still a lot of money still flowing into the market. People are still buying the dip. And I don't think structurally anything is broken. It's more or less high volatility deleveraging happening right now. So I'm ready to take some questions now. Feel free to post it in the chat, or you can unmute yourself and ask those. Um, while we do that, while we wait for the questions, I have just one quick chart to show, which I forgot to show, which is this one. So some people have been asking me the gold, like, is it too fast or is it like, because I know that when we live in a very short duration, we are looking at, oh my God, gold has gone up 2x in like, less than 2 years. So this is a good chart which I found where people were comparing previous gold bull runs, and the red line is the current bull run starting early in last year. And this, if you remember, if you were a part of All Access and if you came to our investor days, we were talking about it in early 2024. We were talking about this is going to happen based on macro. But having said that, that was the start of the bull run. And if you look at the start of bull run and compare with the previous gold bull runs, we are neither in the duration in terms of time period nor in the size of a baseline growth. We have seen this bull run being anything excessive. Again, it doesn't mean that it will continue and it will go more. What I'm trying to highlight here is sometimes we get caught up in this whole idea that it has run up too fast and too soon, that it's within 1 year or 1.5 year, it has gone double. Previous bull runs of gold, it had gone like 10x sometimes, or the bull run have gone on for maybe sometimes a very long period, like 4 to 5 years. So either the length of the bull runs or the size of the bull run can be way bigger, and this is probably still one of the smallest on an average. That is what I wanted to show, because I've been getting a lot of questions from our subscribers or in general when I'm talking to a lot of people, because we were big believer in gold last year and we still believe in it, but we believe that it is not excessive at all. And this is not something which, yeah, just because of the size of the existing move, we are not worried about that it has happened too fast. All right, so I think we have, let me see some question on the chat in the meantime. So I see one question here. What, if anything, precipitated bear market in gold? I think it's a good point. Yes, we have seen decent corrections, like especially what happened in after all of these bull markets in gold. There have always been corrections, and that is, I think, going to happen. Whether it's a normal market conditions. But if you look at the long term after the correction, whether it is gold, whether it is silver, I think silver is maybe more volatile and has seen much worse. But gold, because of the size of the asset class, um, it has moved big and it has also corrected. What created that bear market, if that's the question, I would say it's very difficult to predict. Any assets which is traded in free market, it's very difficult to define what. But I would say usually we see very heavy paper trading of these assets. If you see in modern days, most of the gold and the amount of volumes traded on the futures market or in ETF markets is way higher than actual physical gold. And that's where I think the things become like too frothy. Then you don't know, like the price discovery happens on the futures market, and that because they're so big that most of the actual prices of the physical delivery are designed to follow the futures. So as we say, the tail wagging the dog. This whole principle, which is also seen nowadays in options market in stocks, what is happening is as the derivative markets are becoming bigger and bigger, you're going to see that it's always a tail wagging the dog, and it is more about what happens in the price discovery of the leveraged product. So that's what is always the risk, and that's exactly what happened. And that's why fundamentals don't matter anymore. That's why technicals matter way more in modern world, because if you look at the fundamentals, gold and silver is being accumulated by almost every country which is not aligned with US, whether it's China, whether it's India, whether it is even countries like Saudi Arabia or any kind of non aligned countries, or you can say non-NATO, or even NATO countries cannot rely anymore, because the way the politics or geopolitics is going, there's no more the globalized world or a dollar denominated unity anymore. So what I'm saying is that how the physical demand is, there's an infinite demand right now for gold and silver, and but on the other hand, the paper trading, like there's no other market in the world other than something like London Comex or some of these futures market trade, where which are the biggest markets in the gold and silver. They exist in the Western world, like in London and in New York. And when those things are driving the price discovery, that's where I think it's very difficult to predict fundamentally what will bring the correction, what will bring the change. What we know is that these things can be totally technical driven, nothing to do with the underlying fundamentals, if that was a question. So I cannot predict. I think nobody can predict what will drive this. At this moment, I think what we know is that the physical delivery needs at, like, in this exchanges from gold and silver is one of the highest. Like, there's more and more deliveries being taken. We know that countries are accumulating more and more, and underlying demand is there, and that's what is driving this huge rallies in precious metals. um, yeah, but I think, to answer the question, like, nobody knows when these trends end. What we know is that we can just compare, look at the data, that whether it is unprecedented, whether it is in a low based on historical data, are we in the low probability zone? At this moment, it looks like there is no reason for this rally to stop. But the volatility is rising for sure. So it is not easy to trade on a daily basis if you're not hedged. This is why we always recommend people to look at hedging and not getting into the FOMO of any asset class, whether it is gold, silver, Bitcoin, or stocks. All right. So any other questions, feel free to put in the chat, or we can talk about any other things that are in the mind of people. But other than that, I would say main thing here is, on a day-to-day basis, we are seeing that now market is entering this phase where, in the absence of any specific new news. So remember that we always say that stocks and most of these asset classes, they are trading based on future price, not or future predictions. So the information is already there. So in next 10 days, we have a Fed meeting, there is a rate cut. That is not going to change the market, because market already knows there's a 25 basis rate cut coming. Similarly, December meeting. So I think the policy is more or less a tailwind. Everybody knows it. The probabilities are at 94, 99%, or 100% for next meeting. So when you look at these things, they are not news anymore. They are mostly given certainties. Market has already priced them in. Now, what are the uncertainties are the actual tech earnings, where any beat or any positive news can move the market up, because markets are always skeptical how high we can go in AI trade. Markets are always questioning whether we have overdone with the spending. I think those are the kind of things which will be critical. Same way, I think when we look at gold, silver, and Bitcoin, these are commodities. There is no fundamental, as we discussed. We have to watch on a day-to-day basis how the money flow looks like, how these derivatives trades every day. And because just like stocks had run up too much, and we talked about it for last 2-3 weeks, that there will be corrections. Um, just always remember to zoom out. When you are looking at any big moves, you will very easily see doom and gloom on a day-to-day news networks about, oh, is it end of the cycle or anything. I would say never look at day-to-day moves, look at a bigger picture. As soon as you zoom out, you can easily answer yourself that whether it is the end of the move or it is just a correction which was due, because market doesn't go one way up. It goes up and down, because there are always both side of traders. There are always, like, even if you are a bullish trader and you are taking a bet, you still need to book profits. You still need to close your option positions, your derivative position, your futures positions. And that really leads to, as moves in both directions. And that is something which we need to be aware of and not get impacted by day-to-day moves.
Do you have any commentary on the liquidation cascade and potential flash crash in the crypto markets last weekend, last Friday, Saturday?
Mhm. Yeah, I think not just last Friday, Saturday, I would say even last night it happened. And I would say if you are long enough in crypto, you have seen this. So there are two reasons for it, right? One is we did discuss the gold, silver market and the futures market of the more, I would say, traditional assets. Uh, the difference between crypto is that crypto is a 24-hour product. Crypto has this whole worldwide situation. There is a Binance exchange, there is a Coinbase exchange, and there are certain exchanges which close. Like, for example, futures market close at certain time, and the volume is thinner. Means in recent times we have seen that U.S. markets are way more liquid than anywhere else, because of the BlackRocks of the world and because of the ETFs now coming in U.S. markets and the size of the market. So you will see most of these flash crashes which are happening more and more during the hours when market is closed in US. And this is mostly the reason being, there's an incentive for these crypto exchanges to go and manipulate the price in those off hours, because you have less institutional buyers from US and so on, where BlackRocks of the world cannot buy. And that's where I think if you are long enough in crypto, we have seen this all the time play out. Uh, that's why I think we monitor what are the, like, for example, what are the ETF inflows, what are the institutions doing, because those are the people who are doing it in a more physical manner. Like, for example, a ETF, if they have a cash, like they're buying Bitcoin from exchanges, they need to put it in custody. They have to take deliveries. So these are more regulated areas in US versus price discovery, which can happen in a paper product, for example, overnight. So some of these flash crashes are probably not even real money. They are probably paper money, manipulation happening. And that's common. I think this happens. This has been happening in even in gold and silver on regulated exchanges, and in crypto world you have all kind of unregulated exchanges. So I would not bother about flash crashes. Yes, you should be careful of not playing with leverage. There are a lot of issues playing with leverage when you cannot control what happens with your assets, because I think that's what happens there are a lot of crypto firms which are giving you 10x, 20x, 50x leverage. Those are not worth it, right? Means because the thing is, uh, as soon as, let's say, you have a 5-10% crash, you will see exchanges get a lot of money liquidating people. So, and as the derivative markets become bigger, and it's not the problem of crypto only, right? Means we did discuss that traditionally, gold and silver, the derivative market is probably 100 or 1,000 times bigger than the any real physical exchange happening. What we are seeing now is more and more derivative products in stock market coming. We did talk about a few, many times we have talked in this call how this whole options market is exploding, the zero DTE and so on. So volatility usually goes up around expiry days, around heavy leverage days. So we saw this happening today morning. We saw this happening last week on close, on last Friday. So you are seeing that this the any kind of negative news or lack of confidence in the market will translate into bigger moves when you have so highly leveraged. So that is all I can say about what happened, unless you have anything specific to ask. But I would say, in general, my response to that is volatility increasing means you will have more market makers. People, like, for example, when we do in Proflex, we are big believers in hedging both sides. We love when volatility increase because we make more money playing both sides. On the other hand, when the market is going one way up, uh, you will see less and less people betting on both directions because you can get hurt. So the good news about this is the market autocorrects. So when volatility increases, when these big crashes happen, there are more people who are hedging, who are making the market. They have higher ROI on their investment, and they make the markets even deeper. And when that happens, volatility automatically reduces. So market has I think these open markets are very much self-correcting in nature, so we don't have to worry about it. But yes, as you will see more and more froth in the market, more leverage in the market, and as you see more one directional moves, there will be bigger and bigger meltdowns because of the whole derivatives which are built on top of it.
I guess one question is the Coinbase institutional team members were saying that on a podcast that the market makers for some of these altcoins, like let's say you go outside of the top 10, the market makers completely withdrew liquidity, and then the price was obviously there was no one there to take the bid, and it was in free fall. So what does that mean for some of these coins outside the top 10, like let's say number 10 to
Yeah.
number 200, if they're when the market makers are gone, there's no bid? I mean,
Yeah. So I think this is very common. So I always compare this with, and this is why I think we have been talking about it for last 1 year. There's zero reasons for anybody to go speculate or bet on these smaller coins, which have probably zero value. More importantly, even if you believe in the tech and you're investing in them, there is zero reason for leveraging, right? Because you're relying on kind of a mechanism from this market maker, because most of these projects have probably a few hundred people who are buying, right? And there are thousands of people who are trading. And when market maker disappear, that means there's no buyer. And this is very common. By the way, this happens in stocks also, in penny stocks, in some of the lower liquidity stocks. When you see, means I'm sure you may have seen a stock falling 80%, 90%, which are low liquidity. Similarly, on the way up, sometimes these stocks go up by 200, 300% nowadays. It's not uncommon. And it's mostly because what is market? It's if you have too many sellers or too many people getting liquidated and there is no buyer, there is always going to be price can jump to zero in one transaction. Theoretically, a price can from $100 to zero can happen in single transaction. You need to understand that there is nothing technically stopping it. All you need is there are no buyers, right? So when you talk about things which are not in top 10, those cryptos probably are just artificial markets. They're not even deep enough. There are no real buyers. Everyday market makers were creating this book. And one market maker decided to manipulate the market by saying, let me not give you buy side liquidity and it will come crashing down. And they are incentivized to do it because then they know that they can always buy once it crashes to almost zero, and you can go and buy back and again start providing liquidity. So I would say it's a matter of being stuck in a bad market. This is why we always say there's no incentive as a retail trader to not be in the topmost assets where the liquidity is good. Um, you don't gain anything. It looks fancy. I know a lot of influencers out there who are trying to make you buy some small cap stock or some kind of a tiny crypto. But the idea here is that there is zero risk management, there is zero oversight in some of them, and most importantly, you're not playing an open market because most of these small liquidity things they are being manipulated by maybe 100 people in the market, and they're not even widely traded. So I don't have any specific comments of why something would have happened, but it's very easy to understand why these kind of illiquid names should never be traded by retail people. So I hope I answered your question, but let me quickly see some other questions here. I do see one question about the crypto treasury. Um, yeah, so I think crypto treasury, as I was telling people here maybe a month back. So because I'm very actively involved in some of these, companies who are doing it, like we work with a lot of institutional players in this area, helping them with their strategies on how to monetize these stocks and private deals. But basic idea here is very simple, right? That crypto treasuries as an idea was overplayed a month or two ago when we had every day billions of dollars being raised. And I had raised alarm at that time that it is reaching a state of euphoria. Um, and this happened pretty fast, to be frank, that most of them are now trading below their NAV. And unless you are a MicroStrategy or maybe one of the bit miner where you have some big influencers like Michael Saylor and Tom Lee, these are the only two which are trading a little above their NAV. So I think the euphoria is gone, but on the other hand, the underlying of their yield creation, what is happening, like even as recent as last week, SharpLink, which is a competitive Ethereum treasury from Bitmine, they raised. They did a stock sale to institutions and they were able to sell it at a 10% premium. So and even yesterday, I think there was a new report from I think JP Morgan or somebody, some big bank. They are already talking about now starting to track these treasuries and they're giving a buy rating, giving a price target of 3 times or 4 times beyond where they are. So fundamentally, the bubble is burst already in a way that, and I think Tom Lee said it. So let me give him the credit of saying that earlier this week. He did talk about how the bubble is no longer there. The craziness is no longer there because now all of them are trading at a discount. Having said that, but because they are trading at discount, they are great investments now. Means I was never in favor of them. But if you really believe in crypto, if you believe in Ethereum, buying SBET at a 10% discount to Ethereum value is always going to be better for you. I'm not suggesting Ethereum is a great investment, but I'm saying if you are a buyer in Ethereum and if you believe in Ethereum, why won't you go buy SharpLink, the SBET token? Sorry, the SBET stock, because it is giving you not only Ethereum at 10% discount, but also it is giving you yield because they are staking it for you and generating 4% yield. I'm not even counting the yield generated by the debt and all the other MicroStrategy style investments and the Wall Street um, tools. So overall, I would say right now the euphoria is gone. There was too much of money which was spent in that. And now the question is whether the underlying crypto bull run is over, whether Bitcoin and Ethereum themselves are done in this cycle, and will they go through correction? That will define how these treasuries do because they are naturally, if the crypto price start going up, all of these are great deals right now because they're quoting at below NAV price. So I think that's the status of them. And as I mentioned, MicroStrategy and BMNR, these are the two one which are still quoting at a little bit of premium, but they are also generating yield. So overall, I think fundamentally they are pretty much in a safe domain because now there's no excess, I would say, bubble scenario there. Um, and the good news is that you are seeing, like even yesterday, if you see BlackRock and all these big institutions, they're still promoting heavily Bitcoin and Ethereum. So there's an inherent demand for these top two crypto, and they are like commodity. They are like, as we always say, right, in crypto world, people say Bitcoin and Ethereum are same as gold and silver. So that's how people see them, and they are the gold and silver representative in crypto world. And I do see that demand is still increasing, so I'm not worried about them. On the other hand, I would say the treasury drama which was happening like 2 months ago, where there was too much of a froth, that has been taken out. So it's a good for the market, I would say, because the whole idea of trading these treasuries at 2x or 3x of the NAV and then selling the stock, that was kind of an artificial situation, and now they have to prove on their own feet that whether they can generate yield with standard techniques like debt or not traded by the rotational money coming in from the stock sale. So I think interesting times, I would say, for crypto, because ultimately now it goes back to the fundamentals. The whole tailwind of treasury money coming in is gone. Now whether the Bitcoin and Ethereum themselves find buyers, but then all of these models will start working again, like once the price of Bitcoin and Ethereum start going up. So right now the whole artificial money of the Wall Street is kind of slowed down, we can say. um, but one thing we have to say is the ETFs have not slowed down. So there are multiple people who are pitching products based on Bitcoin and Ethereum, and right now I think the treasury side of the market is slowed down, and the ETF market is still hot. So it will be interesting how that plays out. I think we've taken a lot of questions on crypto and gold and silver. Maybe we can go back to a little bit on the stocks. If anybody has a question on what's going on in the market, we can take a couple of other questions because I want to wrap up early today because of some commitments. So let me know. And let me check if there was anything else on the agenda which we had captured. Um, we did talk about the gold, silver. We did talk about, okay, what are the signals we are watching? I think we are, as I said, we are going to wait for the tech earnings while we're waiting for any of the questions people may have on the tech side of the world. I would say most of the story in this whole bull run, we keep repeating, is around the AI trade. And I think right now the TSM earning is the only earning which confirmed that nothing is changing. We did see, I think now the next question will be, I think as the hyperscalers come out, like the Google, Amazon, and Microsoft of the world, we will see what they talk about, how is the spending going on the software side, on their cloud, are they able to monetize AI? You will see a lot more interest in Meta earnings, for example, Apple earnings, how the iPhone sales are doing. All these things are right now the unknowns, because as you know that we are sitting on a reasonably high valuations in recent times. While money is ready, like we have been talking about macro, we're talking about the tailwind around new money created, but ultimately money can find a different path. Like we have seen gold and silver going up, we have seen even the bonds are going up, the yields are dropping, people are parking the money in more safer areas. So this is more of a safe haven investing which is happening in last 10 days. Now the question is, if earnings justify that there is a lot more growth pending and the monetization is happening, all that money will start flooding into tech stocks again, because then you will reset your expectation. I think somebody had posted, I think our team had posted the fact set numbers that we are expecting 14% earning growth on an average in the Mag 7. Means as I mentioned in the chat, also in the WhatsApp group, that I won't be surprised that 14% is estimate is beaten big time, and it comes out to 20%. Now that those are the kind of reasons which we will be watching. There's no more data, as we said, because of the government shutdown. So we are more or less looking at the rate cuts in 10 days as the next Fed meeting rolls in. And now they're in the lockdown period, so no Fed governor can talk about it. This was the last press conference which Powell had earlier this week, and everything was dovish there. So that is where I think market is pretty much set on stone now that there are rate cuts. So there's nothing much happening right now. Lack of data, rate cuts are guaranteed. We are seeing I think the news of negative. I would say the banks being concerned about their loan quality, that was not great, because while the SLR relaxation happened, if you are concerned about the loan quality, that is where I think this can really create a big problem. Um, so I think this is mostly around what is the short-term confidence level, and that can change overnight with AI trade. Um, so let me see. I see a comment here. What did the people like Diamond trying to achieve by negative comments on economy? I think it's less about they're trying to achieve anything. When Jamie Dimon, if you're talking about Jamie Dimon, if that's what was a typo there, I would say it's more about what he has been. Actually, one thing I have to give to him is he has been very open about the like a commentary about economy, and what he highlighted was that yes, we are living in a tight environment. So he was commenting about the specific losses which they had to take. And as a CEO of a bank which has written off a bad loan of 160 million, it's a big amount you're talking about. So and he is trying to deflect, first of all, from that it's not just my problem, it's everybody's problem. That is one way of, as a CEO, he was trying to deflect that our bank took a loss, but everybody's doing this. And it's an economy problem. So this is I won't consider this as a general, people take that seriously, but people are questioning if he is saying that there is a merit to it, right? He's saying if we have to take this loss, and then we had this regional bank which took another, I would say, reasonable sized loss, I think 60 million or something. So we are talking about these. If you remember, 2 years ago, if you were part of the macro group, we used to have these predictions, right? That there will be so many billions dollars of defaults and hundreds of billions of dollars of credit which is going to go bad. What we are seeing is it never happened. People managed somehow. The health of the businesses were good enough that even though there were bankruptcies in the background, there was nothing big enough. What happened this week was that we had first time some reasonable size of losses being written off by banks, which was some of the worst in recent times. So we are still living in that tight economy. We're still living in the bad loan situations because there are enough businesses who are going bankrupt, because we are living, and we talked about it in Investor Day. We did talk about it many times here in the macro call. Uh, Even though the rate cuts have started, we are still in a very, very restrictive environment. And outside tech, on the big Mag 7, which have a huge cash flow, people are struggling. And I think that's what his comment was, that we have found like there are more cockroaches. The idea was he was trying to highlight that it's not just a single write off, there will be more. And that's what spooked the market. Um, but that is, I think, very well known by smart investors. I don't think it's news. But people got worried that what if we have a 2023 kind of situation where we have more and more banks starting to fail. I think that was a one-day jitter which actually got pretty easily. If you see today's buying, uh, even though we had a bad yesterday, we had this whole concern about the banks. Then we had overnight meltdown in precious metals and Bitcoin. We had a very bad start to the day, and we saw very big buying today. That itself tells you that uh, it's more of a buying opportunity people see, and the people who are making money decisions, they are not too worried right now. So, but I think to answer your question, I would say what Jamie Dimon said was more of he's deflecting from, so that people don't say, oh, how can you make a bad loan decision? And that is unfortunate reality. Most of these banks don't have a very good way to vet their loans and the big loans. And they time to time you will see that the quality of their book is not as good as it should be. So I think people are definitely concerned about how much more defaults are pending. And but I think in general, in the next 12 months, we will see the conditions improving. So hopefully, it's not as bad as it was predicted 2 years ago. We are just seeing some of them showing up right now, and with the tailwinds of what is happening with the yields, I don't think it's a systematic issue yet. And as we always say, right, means if even if the banks fail or these some of these businesses go bankrupt and banks take huge losses, we have seen in past that Fed is always there. So in modern day, I think most of the investors don't even care. They know that they will save the banks. The Fed will save the banks. There is this is all. There is very little political will to let the basic market forces, let more and more businesses fail. There will be some stimulus. There will be some backdoor stopping for from the Fed. So that's what we rely on, and I don't think we should worry about any of these things. These are all buying opportunities when there is a negative comment about bank. All right, so let's take a couple of quick last questions if anybody has. I see another comment about rare metals. Uh, to be frank, yes, rare metals. First of all, we need to understand that it's very much political right now. What happened with the China fight with Trump? It's more of a grandstanding in the negotiations. I don't think any of this thing is going to change. While rare metals are considered rare, they're also China's building huge capacity, and they cannot just block forever because what's the point, right? I mean, they cannot consume all of it. They will at some point come to the negotiation table. Um, so I would not recommend making decisions based on what is happening right now, because I know that a lot of commentators, a lot of analysts, they take advantage of the latest news and they try to promote a certain theme. Um, of course, in long run, all these are great commodity investment because most of these things are already growing, but they may have got blotted in this whole headline grabbing world where today everybody's talking about it. So I always say that if you thought about rare earth metal or all kind of these good opportunities for long run, don't chase them today when the news is hot because of the China and US trade conflict, because right now I see every analyst talking about it probably. And same thing is happening with gold and silver, right? Means why we will see more corrections, because this week when the market was going like up crazy, I saw maximum number of articles, whether it's Wall Street Journal, whether any analyst, everybody's talking about gold and silver right now. And if you remember, like we were talking about gold and silver last year when it was the most hated sector. No, nobody cared about gold and silver in 2024. And if you came to our investor day event, and if you are in part of the All Access, we actually used that as one of the thesis to invest in gold and silver at that time, because it was one of the most hated and so on. So remember this one thing, that when everybody's talking about something, probably you're at the top. Probably everybody is buying right now. So who will be the buyer? Who, if it stops going up, people have to sell now. So just you should shut down this whole news cycle, uh, creating the FOMO. That is my recommendation. If you are feeling compelled because of all the analysis going around you, uh, first of all, it's not a great time to enter new position into gold and silver right now. It's not a great time to get into rare earth metals, or whatever rare earth investments. Let the news cool down. Wait for a few days. Do your own research on individual company strength and the supply chains and so on, and then decide. Because investments will always be there. If they're really good investments for next 10 years, you can wait for another 10 days and then buy when the market cools down a little bit. So that's the only thing I would say. And this stands true for everything. Whenever you hear too much of pressure because of too much news covering it, that means it is just in a form of phase, and a lot of people are right now buying it. All right, so I think this is all. I don't see any other questions. So thanks everybody for being in this call, and I think we are continuing to grow this community. So feel free to bring your friends into the WhatsApp group, and I think we are building pretty good, tight community. So let's continue doing that. Great questions here. Appreciate all of you joining on a Friday evening, and have a great weekend and happy Diwali to all of you. We will talk next week or whenever we have the next macro scheduled. Thank you. Bye bye.